Hey everyone, we all know that financial advice is everywhere, whether it's coming from family, friends, or even financial gurus. But just because advice worked decades ago doesn't mean it still applies today. In fact, some common financial tips are downright and could be holding you back. In today's video, I'm going to break down 15 pieces of financial advice that are no longer relevant and what you should be doing instead. Let's jump right in. This is Wealthlocity. Here you create, protect, and grow your wealth fast. 1. Buy and hold a diversified portfolio of bonds. Once considered the cornerstone of a safe investment strategy, holding a large portion of your portfolio in bonds might have made sense back when interest rates were high. But with today's historically low interest rates, bonds just don't offer the returns they used to. The purchasing power of bonds has been significantly reduced due to low yields and inflationary pressures. Consider diversifying into assets that perform better in a low-interest rate environment, such as dividend stocks, real estate, or even alternative investments like REITs. 2. Keep all your savings in a traditional savings account. You've probably heard this one from parents or grandparents. Put your money in a savings account and let it grow. While that worked when savings accounts paid 5 to 6% interest, today's savings accounts pay next to nothing. Inflation will erode the value of your money faster than the tiny interest you'll earn. Instead, consider high-yield savings accounts, or even investing a portion of your cash in low-risk, higher-return options like treasury bonds or money market funds. 3. Go to college to get a good job. The classic advice for young people used to be, get a degree and you'll be set for life. But the landscape has changed drastically. The cost of college has skyrocketed, and having a degree is no longer a guarantee of a high-paying job. Today, many lucrative fields don't require a traditional 4-year degree. Consider exploring vocational training, certifications in tech fields, or entrepreneurship. Evaluate the return on investment before taking on massive student debt. For decades, people were told to count on Social Security to fund their retirement. But the reality is that Social Security is under significant strain, and future benefits may not be as generous or reliable as they once were. You should view Social Security as a supplement, not a primary retirement strategy. Focus on building your own retirement nest egg through a mix of investments, 401(k)s, and IRAs to ensure you have enough to live on comfortably. The old-school advice was to buy as much house as your mortgage lender would approve. The idea was that real estate values always go up, and a bigger home would be a smart investment. A large home comes with higher expenses, maintenance, utilities, and property taxes. Instead of stretching your budget, consider a more modest home and use the money saved to invest in other appreciating assets. This once popular retirement allocation strategy is based on the idea that you need a conservative portfolio as you get older. But in today's volatile market, the traditional 60-40th split might not provide the stability or returns you need. With bond yields at historic lows and stocks more volatile, this strategy may underperform. Consider a more dynamic approach that includes alternative investments, growth stocks, and inflation-protected securities. Many financial experts used to recommend paying off your mortgage early to achieve financial freedom. While being debt-free is a great goal, low mortgage rates today mean your money could potentially earn more if invested elsewhere. Instead of aggressively paying down a low-interest mortgage, consider investing extra funds in the stock market, where historical returns are higher. Use your money where it has the potential to grow the most. The 10% rule worked well when people stayed with the same company for decades and had pension plans. But today, people are living longer, pensions are rare, and the cost of living has increased dramatically. To retire comfortably, you might need to save 15% or even 20% of your income, depending on your goals and lifestyle. Start early and adjust as your income grows to build a strong retirement fund. The advice to avoid credit cards altogether made sense when high-interest debt and poor money management habits were rampant. But when used responsibly, credit cards can offer significant benefits. Credit cards, when paid off monthly, can help build your credit score, offer rewards, and even protect against fraud. The key is to use them wisely and avoid carrying a balance. A high salary is the path to wealth. Many believe that earning a high salary is all you need to build wealth. But focusing solely on income overlooks the importance of saving, investing, and managing your finances wisely. High earners can still end up broke if they don't save and invest. True wealth is built through smart money management, diversified investments, and passive income sources, not just a large paycheck. Always buy new instead of used. This advice might have made sense when the quality of used items was less reliable, but today, many used products, cars, electronics, and even furniture are as good as new and come at a fraction of the price. Buying new means paying a premium for instant depreciation. By opting for quality used items, you can save significantly and use those savings for investing or building up an emergency fund. Platforms like certified pre-owned car programs and refurbished electronics make buying used a smart financial choice. Work hard, save, and you'll be rich. This is the classic advice we've all heard. Work hard, save diligently, and you'll be wealthy one day. But the truth is, saving alone won't make you rich, especially with today's low interest rates and inflation eating into savings. Building wealth requires more than just saving, it involves investing. While working hard is important, you need to make your money work hard too. Invest in assets that appreciate over time, such as stocks, real estate, or even starting a side business to accelerate wealth building. Your home is your best investment. For many generations, buying a home was considered the ultimate investment. But times have changed. Homeownership comes with significant costs, such as maintenance, taxes, and market volatility. While a home can be a good long-term asset, it's not always the best investment. Many people end up house rich but cash poor. Instead, diversify your investments to include stocks, bonds, and other assets that can generate passive income without the headaches of homeownership. Wait until you're older to start investing. You may have been told that investing is for when you're older and more established, but this mindset can delay your wealth-building efforts significantly. The earlier you start investing, the more time your money has to grow through the power of compound interest. Even small amounts invested in your 20s can result in significant returns by the time you retire. Don't wait. Start investing as soon as you can, even if it's with small amounts. Stick with the same company for job security. Our parents and grandparents stayed with one company for decades, believing it offered job security, pension plans, and retirement benefits. But the job market has changed drastically. Staying put too long can sometimes do more harm than good. In today's fast-paced world, job hopping can actually lead to better pay and more opportunities. Switching companies or roles every few years can significantly increase your salary and help you build a diverse skill set. Prioritize building a career that maximizes your skills and income, rather than focusing solely on job stability. So there you have it, 15 pieces of outdated financial advice that might be holding you back. While these tips may have made sense in the past, times have changed, and it's important to update your financial strategies to reflect the realities of today's economy. The key is to stay informed, adapt, and make decisions based on what works now. If you found this video helpful, don't forget to like this video, subscribe to the channel, and share it with someone who might still be following outdated advice. Thanks for watching, and I'll see you in the next video with more money in your pocket.